right now, there's two speakers I haven't met. So, Christopher Byrne, are you here? He is somewhere. He might be in the dunny or something. Anyway, and Bruce Lane, where are you? Bruce? Oh, short of two speakers. What could go wrong, you know? They are both here somewhere. Bruce, hello Bruce, would you mind coming down the front here so that we can, no sorry I didn't see, I've got all the bright lights in my eyes here, as you will have. Yeah, welcome everybody. We've got a jam-packed show ahead of us. Funny old times, eh? Funny old times. We're just about to get our Prime Minister re-anointed, which is very disturbing for anyone in the mining industry. How would a little coalition between Labor and the Greens go, eh? For Tanya Plibersek's brother Phil was a great geologist, worked in Papua New Guinea and was actually murdered in his own apartment. Gold geologist, ironically. So listen, I just want to tell you a funny little story just to warm us into the political mood of the moment. I have a shareholder called Matt Camonzurli in my company, and Matt, lovely, third generation Italian from out Blacktown Way, and he decided to run in the seat of McMahon in the House of Reps to run against Chris Bowen, who we all love, right? We all love Chris Bowen, nobody lies as well as he does, it blows you away. Well, he's put our whole economy onto the renewables path that's more like a jihad than a gradual transition. He's really committed the country to that and driven our energy prices up. Anyway, so Matt is running against him and he's got the Liberal preferences, and it looks like he's actually going to beat Chris Bowen in his own seat. So as a little favour, I offered to go down and, because he bought shares in my company, I thought, what can I do for you, Matt? And so I'd go down and hand out. No, they made me booth captain for him. Sounds good. But we're going to be there promoting the fortunes of Matt Camonzurli. So even though it might be a bleak night as the polls forecast, keep an eye out for Matt Camonzurli and his contest against Chris Bowen, because it might be quite a sensational evening if the man who created the whole renewable story fails to hold his seat. So, reminds me a little bit of that the Spike Milligan book, which was called Hitler and My Part in His Downfall. So I'm going to have a little part. Hopefully, I'll have a little bit of a part in Chris Bowen's. I haven't done this before, but it'll be fun. So anyway, that's a little story for Saturday night. And tonight we're going to talk about reality. Mineral deposits. Love it. Mines. 4 great shows. We're going to kick off with Jonathan Downs, who has got a party to go to. No. His wife's unwell, and he's responsibly going home to look after her. Respect. Family first, always. So Jonathan will be kicking off. John Welborn will be next. Bruce Lane next, and then Christopher Byrne at the back bringing up the rear. Oh, there you are. Hi, good. Thanks for coming. Yeah. Look, without further ado, it's going to be a jam-packed show. So please, we'll start with the Kaiser Reef story. So take your hands out, bang them together, and welcome to Jonathan Downs to the stage, please.
She broke her ankle and just had surgery, so nothing too serious. Okay, is it right? Oh, I've got one here. Well, thank you all very much for your attendance. I'm actually very excited to talk about Kaiser tonight because it has been a very transitional event that's just occurred with Kaiser. We've now just close to settling the purchase of our third gold mine. We've got 3 gold mines, 2 are in production, and 1 is on care and maintenance that we'll be bringing into production fairly soon. The mine we've purchased is Henty, and I won't talk too much about the process of that because that is something that is all on the public markets, and we're close to bedding that down. So I'll talk on a pro forma basis as if we own Henty now. But it's a profitable gold mine. Catalyst is the current owner, and they just announced their quarterly result. It made about $7.5 million profit for the March quarter, and if you were to apply the current spot gold price, it would have been closer to $11 million. So it's very leveraged to the current gold price. It's got a sort of a fixed cost that sits around $2,800 to $3,200 Australian per ounce. It's got a 5-year mine life, and on that basis of that's using today's current gold price of about $40 million per annum, it's a 1x earning payback for us. So a really sensible business decision just on a standard business 1-year payback with a 5-year mine life. And in addition to that, we have the A1 gold mine. That's a very interesting high-grade mine that's been probably Australia's longest running, almost continuous gold mine in Victoria. And we own the Malden gold mine, which is on care and maintenance. It's a fascinating mine. It produced over 2 million ounces at 28 grams per tonne. So a spectacular mine, sits in between Ballarat and Bendigo. And we've kept that on care and maintenance. So that's ready for a restart, and we're just working our way through engineering works on that. So these mines are at different stages. The Henty mine is obviously doing very well. The A1 mine is being ramped up. We've invested over $25 million to get that, and we're at the bottom of the J-curve, ready to start making some good money there, and Malden needs a restart. And you can see where they're all located, very much an eastern states gold producing business. I'll skip over that because I've only got 15 minutes. I won't talk about myself. I'm a geologist. I've floated several companies in the past, but I'll talk more about Brad Valukas, who has come on fairly recently onto the board of Kaiser. He's coming into the role as the chief. He'll be coming on as the chief operating officer, and his credentials are outstanding. He's a mining engineer who's worked for numerous companies, but most recently he was the manager for technical services for Northern Star, and he worked early on in taking new projects and turning them around for Northern Star in its foundational period. So his experience and track record in mining, turning around operations, expanding operations, increasing production is second to none. And he's a huge asset. The rest of the board are very valuable, but I'll skip past them. You can always contact me later and I'll tell you all about them. Pro forma, the company will be producing last year, if you combine the production, 33,000 ounces of gold. The market cap, when we have settled, is probably about 85 million. We'll have $27.2 million in cash, so well funded, no capital raisings on the horizon. And we have a combined mineral resource of 636,000 ounces of gold at fairly high grades with an ore reserve. Now, we don't have an ore reserve yet at A1. That's coming. We've got a drill rig operating underground there, and we'll have a couple of drill rigs going full-time at Henty as well. So we'll be expanding that reserve and resource base and ramping that production up. I'll probably move past this one as well, and now we'll get into it a bit more. This is just a snapshot of the Henty underground mine. So just for I guess, general background, Henty's produced 1.4 million ounces of gold at nearly 9 grams per tonne. It was discovered in 1993, put in production around 96 by Barrick and Placidome. So big, it was a big company mine and made a lot of money. It did very, very well for them. And once they'd mined the first primary resource, they sold it on, and groups like Unity and Pybar were involved, and Diversified Minerals, and barely a drill hole was drilled in that period of ownership. That was very much a mine the remaining remnant material that they could access easily. There was no forward-looking investment or care. And then in 2021, Catalyst took over, and Catalyst did an amazing job of rolling up their sleeves, drilling it out, and building for the first time. I'll move over to the next slide here. On the left, you can see the resource base has increased despite depletion over the past 5 years, and you can see a maiden 5-year reserve was generated. That resource base, it's a matter mostly of infill drilling to convert that to reserves, and if we were lucky enough to have 100% conversion, which doesn't generally happen, but you can generally get expansion on that, then you're looking at a 15-year mine life. So this is a long-term operation. The graph on the right shows that the Henty made was it 15 million over the year, last year, but pro forma at the current gold price, it would have made much more than that. Should have had my glasses on, $50 million, using a $4,700 gold price, so less than it is now. So taking a view of where the gold price is going and where it's at right now, that's a fantastic launching pad for us as a cash flow producing operation. And there are opportunities at Henty that haven't yet to be realised. For example, when they first mined it, it was a shaft operation, and a decline from the bottom of the shaft to the surface came in later, and it was narrower than the main decline. And so consequently, the trucking is limited to 30-tonne trucks. Now, using a technique that has been successfully employed by Brad at some of the operations for Northern Star, a rotary drum with picks went in and was able to take 30 centimetres off the floor of the drive, very little technical support. Some edges will have to be modified, and they were able to get 40-tonne trucks up. So that was a radical increase in your production. That's just one example. In addition, automating parts of the mill looks like it can add 10 to 15% increase to the processing plant capacity. That's a $1.5 million capex. It's a very small beer for quite a substantial increase in production. And of course, increasing production with a largely fixed cost mine like this is an attack on your all-in sustaining cost, which is going to be one of our key targets. This is another shot of the Henty mill, and I've kind of talked a bit about that. I'll move right through. Henty has actually got some very strong exploration potential as well. The ore body is actually open-ended. The hatched areas show the resources that haven't been mined, and the pink is the material that has been mined. So there's a substantial amount of material that's yet to be exploited. It is open-ended. The zone 96 on the right-hand side has got a exploration drive put in there, and drilling is being conducted. The Darwin South zone is open-ended, and interestingly, you can see a large hatch area on the tearaway area. And if I go to the next slide, probably gives you a better view. I'm going to step off and just point out some faults very quickly. So the Henty mine has been dismembered by a series of faults, and the dream is that we'll find where the next piece of Henty is. There have been some recent drill holes, deep drill holes, that have identified some broad zones of alteration that have all the indicators of what is marginal to the normal mineralisation of the Henty mine. So very exciting indicators, a lot of smoke, yet to find the fire. But obviously the prize is another 1.5 million ounces at 9 grams potentially. That whole corridor where you can see all the prospects continues for many kilometres, and there's high-grade gold and copper rock chips right down that trend. So there is a lot of very exciting exploration potential at Henty. Now, I'll move on to Malden. Malden has the potential to be bigger than Henty and the A1 mine combined. As I said, it says 1.7 million ounces, but if you count some of the alluvial and stuff just to the south off this slide, it's actually 2.1 million ounces at 28 grams. And the very valuable thing about operating in Victoria is having a granted mining licence. And this, I'm pleased to say, has a granted mining licence and has all the operating permits. It's on care and maintenance. It was put on care and maintenance in 2018 when the gold price tanked, so it was a tough time. We have a decline that would probably cost $20 million to replace, that runs right through the guts of it. And we keep it ventilated and dewatered. The water's used to power the plant, the processing plant, which is 2.1 kilometres away as the crow flies. And the water also goes to 35 local farmers to make sure we have good community support. The fascinating thing about Malden is on the right-hand side at the very bottom there's a drive that was 180 metres long. It was 2.4 metres wide, running 16 grams per tonne when they hit a fault that flooded the whole mine in 1913, and no one has ever drilled a hole underneath any of that again. So we are planning to do a lot more drilling. Bit of an inset here. There has been some drilling around the decline, hence the 180,000 ounce current resource and nearly another 300 odd thousand ounces of target resource. But that's all around the drill holes. And you can see from the drill holes, some of the deeper ones on the outskirts of the ore body are high grade. This thing is absolutely continuous. There's no reason there's not another 2 million ounces underneath it. We have line of sight. If we were to drill infill the target resource, I think we'd get to 500,000 ounces very quickly. We'd obviously want to take it to 1 million ounces. We do need to put in a second decline to make an emergency escapeway, and that's probably the only impost to really getting in there and kicking this off. So this is a work in progress. It was shut down when the gold price was $1,650. It's 3 times higher now. So this is a really fabulously exciting prospect. Unlike Ballarat and Bendigo, which it sits in between. Actually, if I go back a slide, you can see the granitoid, the Harcourt granodiorite, has come up underneath it, and it's remobilised all the gold into big faults and shears. So it forms long, continuous shoots, which is quite different from the saddles and spurs that you get in the typical Victorian goldfields, which makes for bulk mechanised mining. You're looking at 2 metre wide, 2.5 metre wide loads, quite high grade, that are just continuous. So you'll use twin and single boom jumbos and get some decent production rates. A special mention also to our processing plant, which is particularly valuable. I personally believe, I hope no one's from the Victorian government here, but you're looking at 10 years plus, maybe to the end of your life, to get another gold processing plant permitted in Victoria because they use cyanide. And our processing plant is obviously operating. We only run it at about 20 to 30% of its capacity from the A1 mine, and it's expandable. So to have this in the heartland of the Victorian goldfields is a real asset. At the moment, we've got 5 toll treatment parties utilising it, but there is ample room for us to expand it and to treat Malden when we bring that on at our own mill, which is, like I said, was originally built for Malden, and so it's only 2 kilometres away, or 4.1 k's from Rompad to Rompad. And finally, The A1 mine, it's a 300-metre striking, 40-metre wide diorite pipe that's come up through the sediments south of Mansfield. And if you take what has been mined recently and what has been mined historically, it's running 1,000 ounces per vertical metre, which is a very rich gold mine, especially in a small footprint. It really makes your production from and versus development cost quite low. And it's a nuggety mine, so it has some challenges, but for the last 40 years, people have been remnant mining, and remnant mining has only given us 250 ounces per vertical metre. So we recognise that we did make some good money out of it. We've had some good quarters. In the September quarter 23, our all-in sustaining costs went down to 1,330 Australian, so fabulous margin. But if we really wanted to make the A1 work, we needed to get to the bottom. So we called the bottom zone, the virgin area, we call it the Nova Zone, and we've spent $25 million, tested our shareholders' patience because it took some time. We invested in high voltage power systems and improving ventilation to the bottom of that mine, which was incidentally what stopped the old timers going beyond 700 metres. It would take 3 days for the air to clear after a blast, so it became impractical for them to keep mining. So we've dealt with all that. I'm proud to say we are now well beyond it. We're over 25 metres below it. We've got drives going through it, and we've just been cutting into the first of the high-grade lodes in the virgin areas. So we think there is a new dawn coming. We've got a drill rig under there at the moment, and we're working hard to put a resource together and get some semblance of a reserve here. But we drilled 2 very deep holes that gave us about a 10-year ahead of the operation look ahead, and confirmed the dike continued. So a very exciting future for A1. We've invested our money. We've got to the point where we're now accessing the high-grade ore. We're below it. We've got a new team in there. It's a real turnaround. So that's, aside from Henty, this is going to be a cash provider going forward in the near term, alongside of the drill results. And that pretty much sums up, I think, was that 15 minutes? Thereabouts? Nice work. Yeah. Thank you very much.
Nice work.
Cheers.
So you're going to shoot through. We'll take the questions at the end, so I'll just answer yours if that's okay.
Fantastic. Yeah.
All right.
Shall I pay you now or
Yeah.
later?
Anyway, ripper story, but great to hear things going so well in the south too, because we don't pay a lot of attention to Victoria, but we should. That's great.
Yeah.
All right. Well, enjoy the party.
Thank you very much.
I hope your wife's okay. Okay. Next is John Welborn, with a man who came out of gold, knows how to run a gold mine, but is now in iron ore.
Did not time that well.
Yeah. So, great big lump of a thing. Feel like I'm having a smoke behind the toilet block here.
I get up too early? I didn't know. Are you going to do a long introduction?
No, I think I'm pretty well done, but you wouldn't want that running at you, would you? Anyway, please put your hands together for John Welborn.
Thank you. Just thought I'd get up quickly before we lost more crowd during Jonathan's boring talk about gold. I'm here to talk about iron ore. Very sexy subject. I know you're all here to listen to it, so thank goodness we're into the main game. You've obviously got the screen in front of you. Great. So the new Western Force in iron ore, it's a little bit of a tongue-in-cheek comment. One, because I'm the president of Rugby WA and played my last couple of games of rugby for the Western Force. And 2, because anyone in mining, and I assume everyone here at the Sydney Mining Club are all deeply involved in mining, would recall the last Western Australian upshot who used that phrase was Andrew Forrest, when he said that Fortescue was the new force in iron ore. No one believed he was going to build something. We're a very different company to FMG, but it's really just a tongue-in-cheek comment, hoping that it pisses him off. I love this photo, though. I do want to just mention that this, I could just talk the entire 15 minutes to this picture because it sums up the current operations of Fenix and our future. And there's a lot in it. And the Sydney Mining Club, first of all, Julian, thank you very much for having me back. There's a disclaimer, which is the next slide. The real disclaimer I wanted to give to this audience is I first came to a Sydney Mining Club function with Equatorial, a budding iron ore project in the Republic of Congo. The shares were about 30 cents. They went to $4. I came back about 10 years ago and spoke for Resolute. The shares were about 80 cents. They went to $2. So none of you have got any excuse. Fenix are trading at 28.5 cents. I'm going to come back and I'll tell you all what they will be in a couple of years. And please listen to the presentation with that in mind. I'm much more excited about this story than anything I've ever done in the mining industry. Back to this picture. In the distance, in the blue sky, you can see the World Range. Iron ore was discovered in the World Range by Australia's first government-paid geologist in 1870. He had an argument with the then Premier of Western Australia, ironically also called Forrest, who believed that the Western Australian government should be focusing on cattle and not mining. So he buggered off to South Australia, where he was basically single-handedly responsible for building their mining industry. And at that point, the vast quantities of iron ore in the World Range lay unexploited. In the last 50 years, people wouldn't know, I need to hurry up through this, but a quick historical journey. Iron ore was actually embargoed. Pig iron Bob Menzies. The first iron ore ever exported from Australia was from Geraldton, and it came from Coolyanuka, not too far from here. And it's because the iron ore in this region was always identified. It's been eclipsed by the Pilbara. Billions of dollars have been spent defining hundreds of millions of tonnes of hematite and billions of tonnes of marketable magnetite. None of it has ever been exploited. They're not big enough to justify railways. They're not big enough to justify the big deep water ports you see in other places. And no one's been able to work out how to exploit them. Fenix has cracked the code. That's the World Range. In the foreground, you can see the highest grade iron ore mine on mainland Australia. And I say that because Koolan Island is off the coast and it's a little bit high. But it's a 65% ore body, beautiful stuff. We've done, this mine is an absolute cracker. There won't be anyone in the gold mining industry now, and certainly in the next couple of years, talking about the feasibility study they did 5 years ago. And the reason is their costs will have gone through the roof. Their revenues, like they'll be making much more money. I'm really proud. Fenix did a feasibility study on the mine you can see in this picture in 2019. We said we could spend 15 million Australian dollars to build a 1.3 million tonne per annum mine, which would have a 6-year mine life. And we would mine, crush, screen, haul and ship iron ore for 85 Australian dollars a tonne. And I know this because I looked at it in detail. I wasn't with Fenix at the time and I thought, bullshit. I next looked at Fenix when they were raising the $15 million to build the mine, and I thought, well, I've looked at the feasibility, I don't think they'll do it. And 3 months later, they were in production. And that's when I bought 10 million shares, and subsequently I've joined the company, and we're now using this as a footprint to build a significant company. Our last quarter, our C1 cash cost was in the order of $76. It's $10 below the feasibility study from 5 years ago. Any other iron ore producer in Australia has seen their C1 cash costs go up between 20 and 50% during that period. We've brought ours down consistently. So that's the mine, crushing and screening, nice bit of product stockpile. The last thing in this picture is a 60-metre quad road train. We run these on public roads. They are 200 tonnes, they haul 140 tonnes. We've now done 50,000 individual 500-kilometre trips between Geraldton and the port of between Iron Ridge and the port of Geraldton. One of the things I really struggled to believe in the Fenix feasibility study, $85 was roughly $25 mining, crushing and screening, $50 haulage, $10 at the port, no G&A, no contingency. $25 crushing and screening looked a bit, mining, crushing and screening looked a bit tight. $50 road haulage over 500 kilometres, 10 cents a tonne kilometre. I thought probably more likely 12. Port, $10, woefully inadequate. What we now do is mining, crushing and screening for about 25, and we haul 500 kilometres for about $28 a tonne. And there is no one else in bulk commodity transport who can do that. But let me use a bit of time to move forward. I've already given you the important disclaimer. Geez, it's great to be an iron ore miner. Everyone wants to talk to you at conferences. They come up, it's great. I made a joke when I spoke at Diggers last that the only time I see my business cards is when I go to the urinal and one floats past. Everyone wants to talk about gold, and there's obvious reasons going through the roof. But let's have a talk about what actually drives the Australian economy. The number one export of this country is iron ore. The richest people in this country, you're probably getting spammed by text messages from big, fat, wealthy billionaires who've made all their money on iron ore. BHP, Rio, they've made the biggest companies in mining in this country have made their money on iron ore. Everyone's getting excited about gold in Western Australia. Diggers this year will be a complete gold fest. The Western Australian government must be absolutely delighted with the royalty income they're going to get over gold going to 5,000 Aussie dollars an ounce. Do you know how much royalty revenue this Western Australian government gets from the gold mining industry? Anyone know? In order? Sean would know. It's about $300 or $400 million. Iron ore, 10 billion. Gold doesn't matter to the Western Australian government and their fiscal budget. What actually matters is iron ore. The federal government, I know you guys don't really care about Western Australian politics or economies, take our GST and ignore us. So iron ore, $43 billion of income tax. The value of iron ore exports to Australia are $120 billion. It is the big kahuna in town. And it's not going anywhere. Everyone's worried about the iron ore price. In the most recent budget, Chalmers has indicated the Australian government, in their wisdom, think that the correct price for the forward outlook is $60. Fantastic. I thought, there's nothing certain that he's got it wrong. So, we're looking good. Every year for the last 5 years, we have tried to convince people that iron ore is somewhere to invest, and everyone has been convinced that it's coming down, and it never has. It is an indicator of global growth. It has established a very strong trading band in and around $100. But the good thing about responsible iron ore mining is you can make money through the whole cycle. So I wanted to have a bit of a rant, and that was the cartoon. But I didn't just stop at one cartoon. I wanted to, second one, this was about the forecasters. They always get it wrong. And the last one was in case I get asked a question, which I often do, about Simandou as the Pilbara killer. No one is more well-credentialed than me, having fucked up a few of them, to show how difficult it is to mine in Africa, particularly in bulk commodity. Julian introduced me as a gold miner. I've operated gold mines in Australia. I've built and operated a number of gold mines in Africa. And I got into that after trying to build bulk commodity iron ore mines in Africa and finding it incredibly difficult. It is ironic that I would have spoken to the Sydney Mining Club about the fact that we all should be investing in Africa. We have seen a screaming U-turn in global politics since then. The internet, Berlin Wall falling down in my early university years, the belief that the world trade was actually moving to a more responsible and consistent model has been proven to be not just incorrect but fundamentally the wrong way. We've now got the most difficult and volatile international trade circumstances we've ever seen. We've got African governments who've worked out that in the old days you could only steal as much money as you could stick in a suitcase, and now you can steal the whole country. And so as much as we might complain about the electoral cycle and the Australian fiscal environment, what a wonderful place to be a miner, and what a wonderful place to be an iron ore miner. So I don't have any problem about other iron ore mines. We are a little pimple in the iron ore market, billions of tonnes going into thousands of steel mills around the world. The production of steel is not going anywhere. It has been very strongly tied to construction in China, but it's also very strongly tied to military spending, to machinery, to anything. Basically, urbanisation, any activity is going to require more and more steel. Right, let's get out of the commodity and talk a little bit about Fenix with the time I've got left. I spoke a bit about the track record. We last raised money in 2020. It was $15 million. We've since paid back $65 million to our shareholders, and we've generated more than $1 billion in cash flow from that $15 million initial raising, $200 million of which, in addition to the $65 million we've paid to shareholders, we've reinvested back into the business and particularly into infrastructure. We built a mine. We've now commissioned our second mine, and we're now building our third mine. We've been very profitable over those years. Last year we had about a $70 million EBITDA, $30 million net profit after tax. That was based on our consistent production of 1.3 million tonnes per annum, and we've traded about 25 to 30 cents forever. We're about to triple our production. We're currently running at 2.5 million tonnes, and in September we'll be running at 4 million tonnes. And the numbers that we're going to generate are really going to surprise people. We're due a re-rate, and that's why I'm here, and that's why I'm talking about it. Here's our neck of the world. come back to what I was talking about where all the iron ore mines are. That map on the right-hand side of the screen, Western Australia. Above where the Western Australian map is to the left is the Pilbara, Port Hedland. That's where all the big guys play. We're in the Midwest. The dotted square is the rest of that map, and we have an incredibly strong advantage. We have storage facilities at Geraldton Port for 500,000 tonnes of iron ore, 3 of the largest on-wharf storage facilities there. We have exclusive access to berth 5. We have capacity to do between 10 and 15 million tonnes at the port, and that is a game changer. Work backwards from that. We don't have a railway. We have a state-of-the-art road haulage network that you can move around like a snake to multiple deposits, and we're starting to show what that system and what that model is all about. Having developed Iron Ridge, having commissioned Shine, we're now developing W11. We're going to move on to a number of deposits in the region. But let me show you what that looks like. We have 3 pillars. So although we look like a mining company, and I'm talking to the mining club, we mine, we're pretty good at it. We've also, that the fundamental part of our business, if you come back to that analysis of where our costs are, is actually logistics. We're a transport logistics company. We own our own equipment, we run it. Most of our employees are actually truck drivers, maintenance workshop people, and liaison officers for our transport logistics business. And then the third pillar of our business, we run a port services business, both for ourselves and third-party customers. We unload material, we store material, and we load material into ships and send it off to global customers. Iron ore is about logistics. It's about integrating those operations as being involved and actively participating in all 3 of those parts of the business. Let me show you what that looks like. Probably need to turn that down a bit. I was going to talk about, so here's Iron Ridge. You can see that really high-grade black ore body sticking down the middle. We keep this really simple, 3-to-1 strip ratio. It's been an incredibly consistent operation. 1 digger, 4 or 5 trucks, very small footprint. We would operate the smallest footprint of any open cut mine, particularly in iron ore in Western Australia. It meant that we've had to be really, really efficient. The reason for that is heritage. This is an incredibly sensitive area. This is a place where 40,000 years ago, human beings, the Wadjuri people, were mining ochre. It's the oldest known human mine in the world, and we're the current miners. Very simple crushing and screening, and then this is the key bit, the integration between our mining activities, loading these wonderful 60-metre quad road trains on their 500-kilometre road trip into Geraldton. Very high tech. Everything about these trucks is managed. A lot of artificial intelligence, and a lot of things that a very mature industry like road haulage, we do uniquely. This is the 3rd biggest city in Western Australia. We drive our trucks right through the middle of it. We've got a depot on the outside of town. It's also a training centre. We do all our own maintenance, refueling, cleaning of the trucks. We've got one of a kind in the world, a driver simulator. This is the Geraldton Port. We have the truck unloader. These sheds, the scale of these are amazing. One of our sheds, you can fit 2 rugby fields end on end inside it. And we load Panamax boats, so 60,000 dry weight tonnes. It takes us about a day to load them, so you can work out what our capacity is. And we send those off to customers, predominantly China, but we also have a range of regional customers who can't accept Cape-size vessels, Korea, Indonesia, Malaysia, and other places. So, with the time I have left, if you think about our 3 pillars, let me run through them. Iron Ridge, we mine it at 1.4 million tonnes per annum, incredibly consistently, a 64% lump product and a 63% fines product. We get a premium price for that. Shine is a lower grade product. We're going to average out about 60% there. We're also being successful at selling a low 52% product. We're currently running that at 1.2 million tonnes. We're going to step that up to about 2 million tonnes a year next year. And the third mine is one we are commissioning as we speak. Commissioning greenfields projects is a much more difficult thing than it's ever been. We've done it twice and we're doing it a 3rd time. We're on track to commission that mine on budget, on time, 3 in a row in the September quarter. Stay tuned for that. That'll be 1.5 million tonnes per annum. That last one is the most significant because if you come back to that first picture and I spoke about the world range and the hundreds of millions of tonnes that are there, those tonnes are owned by Sinosteel, now controlled by Bow Steel. And our 3rd mine is a right to mine agreement we have negotiated with Bow Steel. And we have a 10 million tonne right to mine there. These are little mines. And so one of the things that affects our value is a view that the traditional way of valuing a mining company is look at their costs, look at their margin, and then times that by the mine life. This is the keyhole to the rest of the world range. We're going to nail this mine, and we're going to do a bigger agreement with Baowu Steel to unlock the rest of the world range. That's what we're working on. That's the reason we're investing in infrastructure. We currently have a fleet of about 45 of these 60-metre quad road trains. If you add the value of the prime mover and the trailers, they're about $2 million each. So you can think about the asset value we've got in the business in that fleet. And when we get W11, we've got trucks arriving every couple of days at the moment. We'll have 70 of those road trains, so roughly $150 million worth of fleet working for us by September. We've got a 40-hectare depot training facility in Geraldton. But the real value from an asset perspective in our business is the assets we own at Geraldton Port. So these are owned by Fenix. The insured replacement value for these sheds is $300 million. Much more importantly, they're priceless. If you're an iron ore miner or a silica sands hopeful or a vanadium bulk commodity producer or a potash producer, you're desperately trying to get allocation at a port. You're talking to Cube or Toll or us about how do we get our product into a boat. We have Shed 5, Shed 13, Shed 4. It's 15 million tonnes of capacity. We own them. We own the infrastructure that connects them, the conveyor belts, the truck unloader, and the access to the rail unloader. So we are working backwards from that with our plans about expansion. So, summarising, key catalyst in the next couple of months, we're going to 4 million tonnes. People have got used to us making 30, 40, $50 million a year, depending on the iron ore price, sometimes paying a dividend, sometimes not. But we're about to triple those numbers. At 4 million tonnes a year, we have the capacity and the opportunity to develop an EBITDA of $150 to $200 million, again, depending on the iron ore price. But that's equivalent to our market cap currently. So there's an opportunity here. Clearly, the priority is to expand our ore reserves. We're just building our third mine. We want to keep mining here for decades. We want to do 10 to 15 million tonnes a year. Stay tuned for opportunities on bigger ore bodies. We just missed out on an acquisition of CZR, 30 or 40 million tonnes of iron ore. Rio Tinto came over the top. But we've got other things that we're looking at. And we've got a very small team, and we're just really focused about making money. Myself and the board own about 15% of the company, and we really have a very, very strong focus on delivering value. We've traded sideways for a long time now. Market cap's $215 million. 50 to $60 million of that, depending on the day, is cash. So the EV is embarrassingly small compared to our earnings potential, growth potential. We self-fund. We buy trucks, we have chattel mortgages against those, but we don't have any senior debt in the company. And these mines that we're developing, we have the capital. The W11 mine I mentioned we're commissioning at the moment, $25 million. 15 of that is to build the road to connect the mine. The other 10 is ancillary mining, crushing, screening and camp expansion capital. So these are not hugely consumptive capital mines. We can continue to incrementally build this company, and that's our plan. I really look forward to some discussions afterwards and any questions. Thanks very much for your time.
Well, that's a killer story. Do you go to BMO with this, or...?
Not yet.
Not yet? No. Well, they know you down there from... You've been there with the gold story, so... Looks like it's ready for a re-rate. That's a big company for $215 million. Jeez. Right, well, on with... What a ripping show. Well, great stories. Bruce Lane, could please put your hands together and welcome Bruce Lane to give us the GTI energy story. Yeah. Take it away.
So I'm going to change gears a little bit. We're a much earlier stage company than both the companies that you've seen before. We are developing uranium assets in Wyoming, and in particular in situ recovery assets. So I apologise to anyone who suffers from Trump derangement syndrome, but there is a bit of a background to our story which I think is really worth understanding. So Mr. Trump, very early on in his tenure, announced or declared a national energy emergency in the US, which has given his administration some very significant powers to accelerate activities around mining and energy production. I chose Texas for this chart simply because it was a clear illustration of the amount of energy that's going to be required over the course of, that is about 6 or 7 years. You'll note that the bottom part is data centre activity. The top part of it is everything else. In total, that's about 130 gigawatts a year, so it's about 40 without, even without the data centres. Those are hard numbers to get your head around. If you think a good way to anchor it is that one large nuclear reactor produces about a gigawatt. And in the US, they've got 94 gigawatts worth of production, or 97 gigawatts from 94, 95 reactors that consume about 50 million pounds of uranium. So that's telling you that if you were to do all of that in Texas within 6 years, you need around another 80 nuclear power plants just for Texas. And to put that into perspective, Texas is the 342 number there in the middle, and it's not even the biggest by a long shot in the US. So you can see the number of data centres we're talking about here, and you can tell from that, just simple maths, that the implications for electricity consumption and demand are enormous, which is one of the driving reasons behind Mr. Trump's requirement to get as many cheap electrons onto the grid, firm electrons onto the grid, not unreliables, as quickly as possible. And they are moving heaven and earth to do it. There are a number of factors that or strategies that bring into play, accelerating permitting. I don't know if anyone saw, recently he held a press conference in West Virginia. He had a bunch of coal miners on the stage behind him, and he declared that the federal government is removing all restrictions and all objections to coal mining and coal-fired power stations. So that was about a week or 2 weeks ago, I think. So he's not mucking around. Jensen Huang, if anybody knows who he is, I'm sure you do, from NVIDIA said that, that was only a few days ago, that really he focuses on the key to AI is about taking an electron and turning it into intelligence. So it's all about the electrons. Yes, chips are important, but they are not the limiting factor. So when the US administration talks about winning the AI race, they understand that electricity is everything. The Chinese understand it. China approved 10 new nuclear power plants for construction the other day, and now racing as hard as they can to lead. So where does the electricity come from in the US? You can see there the importance of natural gas. Coal used to be very much the dominant player in the US, much like it has been in Australia. Their energy transition really has occurred by going from coal to natural gas. And if you look at the US, the reduction in emissions was very dramatic over the last decade or so, driven by this transition. They got a hell of a lot of cheap and sometimes free gas out of the Permian Basin. They've been drilling for oil and really focusing on the areas that have low gas, but there is a massive gas field there, and I think it's quoted as being bigger than Qatar. So nuclear is 20%, or roughly has been 20%. It's 50% of their clean energy. And if you're a data centre provider and you're looking for clean energy sources, nuclear is one of the very obvious ways to solve that challenge. And of course, that leads me to the implications for uranium. So at the moment, the US demand is about 50 million pounds a year. So you see at the bottom of that bar chart. There's a forecast out which says by 2035 they'll need an additional 17 million pounds, but that's not taking into account their pledge to triple nuclear power, which would kind of give us about 150 million pounds demand. How much are they producing? That's the other chart, about £1 million a year, so nothing. I asked ChatGPT what 50 million pounds of uranium looked like, and that's what they said. I don't know if that's accurate, but that's what it came up with. So this mess of a chart is actually one of my favourites. And look, what I'll do is I'll step out here. So you can see the US was a very major producer of uranium, self-sufficient, 44 million pounds. Then the megatons to megawatts program kicked in, where they downblended Russian enriched uranium from warheads and sold it to nuclear power plants in the late 80s, and that absolutely killed the domestic uranium industry. Producers could not produce it that cheaply. You see what's happened since. The Kazakhs now are a very major player in uranium. At the same time, Rosatom, the Russian-owned, state-owned nuclear company, which is an end-to-end nuclear company, acquired some of the largest uranium assets and enrichment assets in the US through the Uranium 1 acquisition. If anybody's interested in the Clintons, go have a dive down that one. It's really interesting. So there's been recent noise about the US banning Russian uranium and then Vladimir Putin counter-banning it. That's all taken place. There's a few waivers in place, but ultimately the US is not going to buy any more Russian enrichment, and it is really important to them. It's about 25% of enrichment supply, and enrichment's a bottleneck. So it all matters, and it's all influencing the price at the moment. So I asked Grok 3 what the price of uranium was going to be, because I could give you all the charts and all the other rubbish, but and it's actually very, very well referenced. So Grok 3 says $90 to $110 by 2027, and if there's any kind of interesting events in the world, it might go up to 120 to 140. At the moment, it's the term price is around $80 a pound. Spot price has been about 64, 65 recently. It was about $100 odd at the start of last year, and it's tracked back, but it's on its way up again. I think it's back up to $68. That long-term contract price at the moment of $80 is enough to make our project, we believe, to make our project profitable, and that is the reason why mines around where our project is in Wyoming are getting back into business. So I'll talk specifically now for a bit about our project. As I said, in situ recovery uranium, subterranean mining, basically using a solution in Wyoming. There will be some forward-looking statements. I'm not giving you investment advice. Please do your own research. Key takeaways I want to give you today, and there won't be a lot of detail and geological charts. I'm not going to show any drill holes. I really want to talk about this at a conceptual level. If anybody wants to know more, please come and talk to me. So we are the only junior company in Wyoming that has JORC-compliant resources. All of the other companies are large companies that have either production facilities or permitted facilities, and a lot of those, as I said, are getting back into business. We're on track for a scoping study. That'll be during this quarter for our project. And neighbouring alkaline leach ISR operations show very positive economics, and that's why they're getting back into production. Look, recently a project which abuts our project to the north called the Pine Ridge project was sold for £22.5 million, and I'll come back to the valuation, but that implies a sort of mid-case of 60 cents per pound in ground for an exploration target, not for a defined resource with a study or anything, just for an exploration target. And our valuation at the moment, our market cap, suggests a price per pound for JORC-defined resources, of which a chunk is inferred and a chunk is indicated at 60 cents a pound, and we're about to have a study. So we think we're cheap on that basis. So we've got 8.57 million pounds at our Low Herma project. To give you an idea, at sort of $80 a pound, $600 or $700 million of in-ground value. We've got 10 million pounds in total, with an exploration target upside of up to 20 million pounds across all of our Wyoming projects combined. We've got a bunch of projects, but we're very much focusing on that Low Herma project. We really don't have the capacity or the finance to do much else, and that is where we think we're getting best bang for our buck, and we've got the fastest route to production. So just to look at the location, that splodge in the middle is where the Low Herma project is. That project there is the largest permitted in situ recovery project in the United States at Cameco. Just down the road here, our other projects are next to Lost Creek, owned by UR Energy, which is in production. So that one's in production. There's one up here in production. There's another one getting into production here. It's coming back to life. So in situ recovery, I won't dwell on this, but we pump a leach solution into a subterranean contained ore body, and then that leach solution liberates the uranium and we pull it to the surface. It goes onto an ion exchange tower, and then the resin beads attract the uranium, and then the uranium is extracted through a process of elution, precipitation, drying, and then it goes in a drum and it's yellow cake, and you can put it on road transport and take it away to Converdine's facility at Metropolis in Illinois. No international shipping. It's kind of just down the road in Australian terms, I guess. The photo there of Smith Highland Ranch, that's the largest plant in the US, and then the one on the right is a kind of conventional open pit, that's Rossing. So it gives you an idea of, from an ESG point of view, environmental impact point of view, it's a hell of a good way to mine stuff, particularly if you're using alkaline leach and you're not liberating any nasties into the groundwater. So the producers that are back in production, as I said, Lost Creek is Energy listed in Canada. Willow Creek is UEC. UEC is the largest uranium company in the United States. Energy Fuels at Nichols Ranch are thinking about getting back into production in August. And then I think a few of you may be aware of Peninsula at the Lance project, which is about 100 miles north. Key difference with Peninsula, it's an acid leach project. It's in an older formation, tighter sands, marine depositional environment, much tougher from a metallurgical point of view. Most of the rest of the projects in Wyoming are in younger formations, and the metallurgy is very simple. We're just trying to move the pH a couple of points underground, and we're just essentially using baking soda to do that. So it's a very benign process. So the green bit in the middle of this chart is that Pine Ridge project I talked about. Our project is the yellow one below it. The trends in our property run through into that other property. That's the one that somebody's just paid $22.5 million for, with a 5% net smelter return, a $10 million commitment in the first 2 years, and then a commitment to production in the 6th year. So it's a hell of a deal. We're a lot more advanced than that project. The other deal recently that's probably worth looking at is UEC paid $175 million for these projects around us in the Great Divide Basin. They say there's 170 million pounds there. All of it's historical resource, and there is a mill permit. But it just shows that there's value in these properties, and there are transactions out in the marketplace to support that at quite high valuations. So we updated our resource at the back end of last year off the back of some drilling, and then that set us up for our scoping study, which is the key activity at the moment. Next year, later this year, assuming we get the funding to do that, we think we can expand the resource. We're very confident we can expand the resource with a bit more drilling and move on with the permitting process to try and get the asset into production. Just look at the time, 13, okay. So I've already said all that, done all the studies, done the metallurgy, done the hydrology, and our scoping study is in the works, due to be out in the next few weeks. Now I want to draw your attention to two projects just to give a bit of a line of sight. This one here, which is the Shirley Basin project, which Energy are building as a satellite mine for their central processing plant. So they're going to truck resin beads from the mine 32 miles back to the plant to be processed. The other one is the Gas Hills project owned by Encore. They are going to truck that probably across to their Dewey Burdock project, or in fact they could truck it to Texas, because once you've got the uranium on the resin beads, it will stand the transport for very, very long distances. It's a very high value product. And looking at those two projects, you see the top one, Shirley Basin, about £8 million, very attractive economics, $120 million NPV, 83% IRR. These things pay back in a couple of years. Gas Hills, similar size. These guys are using assumptions of just north of $80 and 87 in the case of the Gas Hills project. Good NPVs, very attractive IRR. So that's the sort of project we're trying to create, and our study will position it either as a central processing plant or as a satellite. The satellite plant, your avoided capital is about $8 or $9 million. And you just have to find a partner to do the resin processing. So those are the options that we're trying to generate. Look, on the board, Matt Hartman, based in Denver, he's an ISR specialist, has worked on a number of ISR projects in the area. Simon Williamson was the ex-general manager of Cameco in Australia. He's on our board, very experienced with feasibility studies and getting things done. And Jim Boffman, he's also based in the US. He ran High Plains, which was sold to Uranium One back in 2006 for $55 million. So he understands how to get an exit. So that's the key members. And market cap's very modest, $9 million. It has been much higher when we've been much less advanced. That says cash of 1.2. We're down to about 900 in this quarter. That's the previous quarter, about 930 at the moment. So that's where things stand. And I'll finish off with this, just a comparison of valuations. You can see there that Premier American Uranium, it's got 20 million pounds and a market cap of, I think, what is it? That was 70 million bucks roughly. Our market cap with 10 million pounds is down around 6 million US dollars. So we think, and compared to some of the other peers there who don't have assets, we think our valuation is very modest. We think that with what's happening in uranium and the cycle in the US and the opening up of permitting, and I could go on for hours, we think that it's well worth a look right at the moment. We think this could be the moment where people can make some money. So look, by all means, scan the QR code, get in touch. Very happy to have a chat with anyone afterwards, and thanks for having me here tonight in this illustrious company. John, I thought your presentation was fabulous. I stood on top of Iron Ridge about how many years ago and battered away the flies. I could never have kind of imagined that progress, so congratulations. Thanks.
How good are these stories? I mean, which one do you buy? You've got to get them all, right? Sensational. I just love Australia. You just these enterprises keep coming. There's so much capability in our country, so many smart people, and they just keep on. You just keep hearing about things you never knew about, and that's amazing. So, in our last one, we're going to hear about. Actually, by the way, it was nice to see the mention of Energy Fuels just brought up to 29% in my company. So it was great company too, good boys. Yeah. Yeah, a little talk about myself for a change. Anyway, sorry? What's the company name? Don't get me started, mate. Tape Transition Metals. They're interested in our NdPr. So, talk about somebody else again. Please make welcome to hear the legacy minerals story, Christopher Byrne. Here we go. Good luck, mate.
Well, thanks everyone for being here tonight. It's a real pleasure to present the story again. I think it's about 12 months ago I was up here. So it's been a big 12 months for us. We've really made some significant strides across our New South Wales focused portfolio, particularly with this year a maiden MRE of 1.2 million ounces gold equivalent and a scoping study both delivered last month at our Drake project. Talking about New South Wales, we're solely focused on this jurisdiction and we think it's arguably the best jurisdiction to make discoveries in Australia. We've got 9 projects covering close to over 8,000 square kilometres, so that we're the largest ASX listed exploration company in New South Wales. And it's not just our view on the jurisdiction as being prospective. We've seen since 2023 16 billion in M&A done across the state and 300 million in exploration joint ventures done. So we're looking at all the global majors are taking positions in New South Wales, Newmont, Anglo Gold, Fortescue, as some of the Australian-based ones. And some of the reasons is that New South Wales is home to Australia's largest gold mine at Katie Ridgeway. And it's seen a wealth of, exploration assets been underexplored and that potential unrealised. A lot of the money spent in Australia over the last couple of decades has been in WA. So what it's meant is that there's plenty of discovery opportunities across New South Wales. We've got a portfolio that combines these 100% owned projects as well as joint ventures. We signed Newmont on as a partner last year, Earth AI and S2 Resources led by Dr. Mark Bennett, who are all farming and spending money in on our ground in New South Wales. To touch on the legacy minerals as a company, we've got a market cap around 30 mil, 125 million shares on issue. We're seeing great sort of liquidity at the moment as the junior market's been really excited around the gold price. Our portfolio is quite unique in that we've got these significant projects as well as these joint venture partners that fund our exploration, and we're loan carried through to commercial production on 3 of those projects, including the one with Newmont. I'll talk briefly about our board, led by Dr. David Carlin from Rex Minerals, ex-chairman, and our recent acquisition or that joined us, Dr. John Greenfield, ex-principal geologist of Newmont, director of the Geological Survey. So between those two people alone, we talk about the expertise that can see commercial transactions delivered, like Rex Minerals with that takeover, as well as the geological and technical competence that we sort of see in that exploration team. So most of this presentation I'll talk about Drake. Drake's up in northeastern New South Wales, and it's a bit of a forgotten mining district. They were mining up here in 1853 till 1993. So we're talking about one of the oldest continuous mine districts in Australia. So pre-Broken Hill, pre-Cobar, they were liberating gold, silver and copper up in this jurisdiction. That resource, 1.2 million ounces gold equivalent. It's about 50% gold, 50% silver, so around 102 million ounces silver equivalent. We really like this project because what we're looking at here is a system that aren't known to host, a million ounce deposits. You're talking big multi-million ounce systems. So we're looking for a Porgera-sized epithermal porphyry copper system. It's one of the largest mineral systems in New South Wales. There's around 4,000 historical mines in the 160 square kilometre caldera. So you're talking about an extremely target-rich environment. The 1.2 million ounces JORC resource that was announced last month, that's all open pittable, and that's unusual for this type of deposit. Normally, these are high-grade underground deposits that you often see, particularly in PNG. What we really like is the multitude of 100-gram metre gold hits that you see across the project, all very shallow. So we're looking at a mineral system that starts at surface, 12 metres at 48 grams gold, 2,500 silver, very, very high grade. That's what constitutes the existing open pits. That current MRE doesn't have any underground resources in it at the moment. So there's some pretty clear upside to that target. What we also like about it, Rex Minerals, back in 2007, drilled a hole 18 metres at 5.9% copper from 58 metres, and another 10 at 7 in the same drill hole. Never followed up. So they're the types of grades that, if you were to be mining that at CSA at Cobar, a kilometre deep, that's their economic copper hits. The copper story at Drake is yet to be told, and we've really got to focus on looking for, these potential large porphyry copper drivers that have, bled this massive amount of fluid and mineralisation into the district. That's the MRE. It's made of 4 principal deposits, the Mount Carrington area, White Rock and Red Rock. And again, it's located in a location in New South Wales that's really enviable from an infrastructure perspective. So we're grid connected, 132 kV. We've got existing tailings dams, freshwater dams that have been built on site. The open pits are pre-stripped. The haul roads are built, and what that translates into a scoping study is some pretty phenomenally low capex figures and low all-in sustaining cost numbers as well. So we announced this phase 1 scoping study about 3 weeks after our MRE, which is a pretty record pace time to be putting out a scoping study on a project. And the reason why we're able to do something like that is that we're building off around $50 million in previous expenditure on the project. So there's been a significant amount of sunk capital on the project that we've been able to really utilise in terms of that study. At the base case of 4,250 gold, it's got close to a 300 mil NPV, 112% IRR, free cash flow of over 300 mil. And importantly, the mining metrics are sound. So we're looking at an operation that produces an all-in sustaining cost at 1,700 Aussie. It's open pit and around 34,000 ounces per annum. And it's got a 47 mil capex. So again, low capital expenditure to get into production. What we really like about that project and the upside is that scoping study is based on 200,000 ounces out of our 1.2 million ounce resource. So when we look at the additional 450,000 ounces of gold and 23 million ounces of silver that have yet to be incorporated into a study on the site, that's going to represent some significant upside. Obviously, when you start to look at the spot price valuations there, you start to talk about some pretty high numbers from an NPV perspective as well. Again, the importance of an advanced project in New South Wales is that infrastructure consideration. So when you look at that key critical, contentious bits of infrastructure like tailings dams, like the freshwater dam supply, the continuous mining history, and the fact that we sit in a state forest, they're all very, very positive signs to see a project of this sort of scale get developed. This is what the sort of setting looks like, and I'll briefly talk about the geology and why we sort of see that this MRE and the scoping study underpins a strong valuation case for our shareholders currently, but it's really the exploration upside and the growth of these types of systems that present the big opportunity. They're the 4 deposit areas, Red Rock, White Rock and Mount Carrington. There's been virtually no exploration and drilling done between any of those 4 deposits. So very much focused on the old historical mining licenses that were granted, as I said, from about 1853 onwards. What we sort of see in this system, a great analogy is the K92 discovery story in PNG. So again, we're looking at a similar geology, the epithermal intermediate to low sulfidation epithermal system. That was acquired off Barrick back in 2015. The resource then was 0.8 million ounces gold equivalent. By 2017, that was 2.2. And as of 2024, that's 18 million ounces gold equivalent. And that's come from good systematic exploration, a great team of geologists that have understood the system, understood how these systems are formed, deeper drilling, as well as regional exploration. So they stepped away from the main deposits at Cora and Judd and looked at these other porphyry potential prospects and drilled them out. And it's really exciting to sort of discuss with those geologists that have resulted in such a transformational turnaround of an asset. That really like the analogy that we present at Drake and as shareholders in the company. They're just some of the textures, again, getting quite technical from a geological perspective, but these are why a lot of the academic experts make the technical comparison between the Drake system and a lot of these big Pacific Rim porphyry copper gold systems. Lastly, and I don't know if this makes it easy to sort of talk about, particularly as an MD, it does, the value that we see in Legacy. We're currently a 30 mil market cap, which is a significant growth from where we were, even 6 months ago. But when you start to benchmark other epithermal low sulfidation systems that are listed on the ASX and look at that market cap per ounce in the ground, there's some pretty good comparisons in terms of that growth opportunity that we sort of see in the project. We're, as a new resource, relatively undervalued, so it's certainly my job over the next couple of months to really get that message out that we've got a lot of room to grow, from a market cap perspective and deliver for our shareholders. And we're expecting, as I said, that resource to grow even further as we look to drill out the underground deposits and drill some regional exploration targets as well. The next steps on that project, I talked about the scoping study that we did. We're on to examining what a phase 2 scoping study looks like. And again, that's bringing that additional 450,000 ounces and 23 million ounces of silver into the resource and into that study, as well as we completed an airborne magnetotelluric survey. So that was the same geophysical team that was deployed at the K92 project and was really instrumental in their regional growth and the discoveries of some of their big systems, including the Blue Lake porphyry as well. So we're expecting those results to come out within the next couple of weeks, as well as drilling results. We put some drilling results out today, 95 metres, I think at 0.9 grams from surface, including high grade zones, 10 metres at 6. They were geotechnical holes that were drilled by the previous company, never assayed. We quickly realised that they carried significant grade from looking at the visible sulphides in them. A lot of those holes sit outside the existing pit shells, and they also provide, near-term opportunity to look at infill grade uplifts across that resource. So I'll talk about Thomson because Legacy is not just a single company focus or a single project focus on Drake. We've got this package of tenements, again, that are 100% owned and under joint venture. And one of the other key flagship projects that we're progressing at the moment is the Thomson project. This was last drilled in 2011 by a company called Thomson Resources. And they were looking for cobalt-type deposits, essentially. What we saw and what they saw, and back then was, a bit of drilling that indicated that they might be looking at an intrusion-related gold system. So back in 2011, that didn't mean much. When you look at the work that's been done in the industry since 2011, from an intrusion-related perspective, there's 3 major deposits that have been found, which is Hemi, Havieron, and Winu. So you're talking 30 million ounces in gold equivalent resources for these types of systems that really just weren't understood academically or even from an exploration perspective what people were looking at back then. So we pegged, it's one of the largest single gold copper licenses in New South Wales, covering 5,500 square kilometres. And what's really exciting is these bullseye magnetic features. So while Drake, really underpins a strong value proposition in the company from a market cap per ounce in the ground perspective, this presents that big near-term discovery opportunity where, a single drill hole like they had at Winu can result in an absolute substantial discovery. To give perspective on the scale of the Thompson project, that's it compared to Hemi's from a intrusion-related structural perspective. So we're looking at a significant exploration exposure where we've got not only the control of a camp scale project, but a district scale system here. Geoscience Australia considered this to be the most underexplored geological terrain in Australia, and we all know, the classic De Grey story, that when they were looking for their intrusion-related systems, they were looking in an area that was considered unprospective, and it's delivered some tremendous results for those shareholders in terms of that recent takeover. What we're looking at in terms of the actual targets that we're looking at on the Thompson project are these coincident magnetic and gravity features. Historically, when the targeting was looking for Cobar type deposits, the focus was on drilling the magnetic anomalies. And what occurred there was that the coincident gravity features, which hung off the side, remain untested in these targets. We went back and reassayed a lot of the historical core, 377 metres at 0.1 grams gold, from what we're calling a near-miss hit at one of the targets at Cut A. So that hasn't tested the gravity anomaly. So this is the type of drilling where a rig in the other direction, coming down through the heart of that gravity feature, and looking to replicate these big, broad intervals with these high grade veins, and that's what you need to sort of stack up, to get your Hemi and your large intrusion related gold deposit systems. So lastly, I'll just briefly talk about the joint venture projects, 28 million in JVs with Newmont, S2, Earth AI and Helix. We really like joint ventures because it gives us that exposure and sustained discovery success. And so both Newmont, S2 and Earth AI, they're going to fund legacy minerals through to commercial production, so we don't have to pay anything further, and we'll own 20% of an operational asset with one of those partners. I'll just talk about what Mark Bennett's doing at Glen Logan. We pegged this ground. He farmed into us last year. They've identified a target which they're gearing up to drill in May this year. Sitting South Acadia, the ground around us has all been joint ventured into by Goldfields a couple months ago. Really high conviction, we're looking for Acadia style target here. What we sort of see in those partnerships is not only that the funding that's spent on our ground, but the geological confidence that these types of big prospectors like Creasy and Bennett bring when they're sort of backing some of our conceptual, high risk exploration plays. So they're sort of great partnerships to have as a junior. So that's it to wrap up the investment case. That 1.2 million ounces sets a really strong foundation, for the company. Our market cap presents significant growth opportunities throughout the rest of the portfolio. We're focused on gold, copper and silver. Don't need to talk about the market, thematics around the strength of those. We've got backed by tier one partners and a tier one management team as well, and a real clear strategy to deliver value for our shareholders. So with that, thanks, Julie.
Didn't want to go through the sponsors at the outset because we had 4 in a row and we just wanted to see we got through it in good time. We do have some time for questions now, and while the guys are coming up here, I just want to tell you some pretty exciting stuff for your club. You'll notice last time we had the new sponsor, which is Broken Hill Mines, absolutely revolutionising the Broken Hill field. And you'll see here now we have IMARC. We have a partnership now with IMARC, and there'll be advantages to members. You'll have cheaper enrolments, but there's a They are financial supporters of your club. I'll run through the rest of them, but before I just leave IMARC, they're doing a special program on it's called Next Gen. It's about getting kids who are at school interested in mining. Really important. You know, like we all sort of want to do it, want to find some way to help. That'll be a program that you'll be hearing a lot more about here, and what a great thing to be doing together. I mean, IMARC is enormous. It's just one of it's become like the living diggers and dealers in the shade. It's really one of the great mining shows of the world, and so it's really nice to have them in giving your club financial support. As a reminder, you don't pay for your membership because of these sponsors, and the sponsorships go a long way to covering the enormous costs of presenting things at Merivale. You know, things ain't cheap in Sydney. So the other new one, of course, is in Versia, and so we've got very strong sponsorship. I'll just mention the rest because we really appreciate them. CRE, the mining insurance guys, Veritas broking firm, New South Wales Minerals Council, Steve Galilee's often up here as your host, Research as a Service, Finola Burke, who does great work on a lot of companies and does a write-up, and everyone who presents up here gets a write-up from Research as a Service. APM, as our old mates who do a lot of our backroom work. Kingsgate Consolidated, Taurus Funds Management, thank you, Nick. RFC Ambrian, Fender Geophysics, doing very run off their pants, off their feet at the moment. AMEC, the Australian Association of Exploration and Mining Companies out of the West, predominantly. TEAS and Ioneer, the great lithium developer in Nevada in the USA. But the key long-time big hitters are BDA and AME Group. As I say, when you talk to these guys, any of these companies, tell them thank you. Thank you for supporting your club. They make it possible, and better still, give them your business. So just a small round of applause for our sponsors, please. And gentlemen, could you get up on the stage all together, and we'll just we'll knock over a question, quickly get through some questions that we've probably got a roving mic, but it's a pretty small room anyway. So would the speakers like to come up and get back in the spotlight up here? But absolutely sizzling stories. Have we got any questions going around? There's one there. We'll start Barry first. Yeah, you guys can just come down to the mic when you get a question.
Great presentations, guys. John, your 60-metre road trains, can you tell us something about the technology involved in it that allows you to bring those things at $25 a tonne?
Sure. The question, in case people missed the start of it, was can I talk a little bit about the 60-metre road trains I mentioned and
your favourite subject,
and the technology within them, and also explain why we're able to run them so efficiently. So the first bit's pretty easy. We only use Volvos. Craig Mitchell, who's my fellow director of Fenix and was the founder of Newhall, which was a business that we originally were in joint venture with and then we acquired, and that's really the strength. Craig is one of Western Australia's most successful entrepreneurs. He started a business called Mitchell Transport with one truck. It's a Lindsay Fox story. He then sold that business for $150 million to Toll about 15 years ago. He started Newhall because he wanted to just do one thing, which was move bulk commodities long distances. Fenix was his first client. He said, I don't want to be a contractor. Every dollar I win is a dollar you lose. We'll do it open book. So your feasibility study says $50. I reckon I'll do it for 30. Sorry, do you reckon you'll get... His first conversation was, do you reckon you'll actually get 50? And Fenix said, yeah. And he said, I don't think you will. I think it'll be 54. But I'll tell you what, I'll do it for 50, but I'll only do it in a joint venture. So you put up half the money, I'll put up half the money, and we'll split the profit that we make for me doing it less than 50. So it's a great deal for Fenix. So I mentioned that we're doing it for 28. So if that joint venture was still in place, Craig would be making $11 a tonne, and there's 10 million tonne ore body. So it was a very profitable joint venture. We wrapped it up. He's now the largest shareholder of Fenix. He designed the trucks, to answer your specific question. Wow. So they're a Western Australian built trailer combination, quad road train. They're incredibly stable. They're designed to do exactly what they do. They're designed for what we do, as opposed to most people buy trailers, combinations. You go into a logistics yard of one of our competitors, they've got Hiachis and Macs and Volvos and Fords and every other type of car, and they've got doubles and bogies and triples and quads. We operate one type of trailer and one type of prime mover. We have a relationship with Volvo. We trial a lot of their technology. So that's the very specific design for a very specific purpose. The answer to the question as to how we're doing 5 cents a tonne kilometre when the industry norm is 10 to 12 isn't an easy question. It's not one answer. I probably takes half an hour, but if I did it very, very quickly, we allow the truck to drive the utilisation. Almost everyone in the transport industry, the driver, the individual behind the wheel, drives the utilisation of the truck. He's either asleep or he's in the wheel, or you've got a second one driving in, FIFO. Our trucks are more like a sushi train, and we have the drivers who just get in and out of them as they're rolling almost. We have a lot of AI. We do light touch maintenance only. We only use brand new gear. When I mention when I bring people to Geraldton, I have to drive past them from the airport, all our competitors, Toll, Cube, Mitchell, Patience, and a whole lot of other bulk commodity transport logistics companies. And their yards look like a transport logistics yard. As you saw in the photo, ours doesn't. It's very different. We run the business completely different. When you and I go to Brisbane and get in a hire car from Hertz or Avis, we're not surprised it's pretty new, we're not surprised it's clean, and we're not surprised it doesn't break down. That's not the experience of most truck drivers driving, you 50-degree latent heat on the other side of Yalgoo, standing next to a quad road train with a blown turbo is not our business. We run brand new gear, our drivers get in it, they punch in their code, they've got a retinal scan, they've got a pulsometer, they've got 150 different points. One other big thing is we pay them a bonus, $500 to the top 20 drivers in our pool. The bottom 20 have to come in and do a remedial session with the supervisors as to why they're in the bottom. We publish those figures. It's like a shearing shed. We're such a sporting focused country in Australia, so we make it competitive. It costs us about $1 million a year in bonuses. Once we instituted that, we saved $4 or $5 million in fuel. The last thing of one, I could go on and on. 500 kilometre journey, I mentioned, there's hills, there's dips. We've now done 50,000 trips. We've studied every hill. We tell the drivers what speed, what gear ratio to be in. We actually change the truck setup for the roads that they're on. The drivers are trying to get their bonus, and so they're working on, how do I say, these things, the round trip 500 k's, 1,000 kilometres uses 1,000 litres of diesel. If you can rev it up the big hill on the other side of Yalgoo, you might save a couple of litres. It might take you an extra 20 seconds to get to the front. So there's an analysis ongoing all the time of how do we get these things efficient, how do we save some fuel, how do we run our maintenance program. No one else in the industry does what we do to take a 10-cent cost to a 5-cent cost.
Wow. Jeez.
It's a hell of an answer. Next question over here.
Hello, another question for John. You've obviously done a lot of work to go from 1.3 to almost 4, and then you'll be at 4 soon, so well done. Looking forward in the medium term, you alluded to getting to your port capacity of 10 million, and you've obviously just been disappointed by the CZR transaction, which is not proceeding. Can you talk a little bit about what plans there are in the medium term to go from 4 to whatever it might be or beyond?
Yeah, sure. I spoke in this audience about iron ore. I actually haven't been speaking a lot about iron ore. The truth is I've actually been a bit bearish over the last couple of years. I'm more bullish on iron ore today, given what's happening in the world, than I have been for a while. If you'd asked me this question 2 or 3 years ago, I actually had a map we used to show up which showed 140 projects in that little area of interest where we've got our existing mines that are currently doing feasibility studies. And they're vanadium, potash, talc, garnet, silica sands, base metals, magnetite, hematite, and anything else you can think of. And so we were originally very interested in diversifying away from iron ore with a view to getting into some sexy transition metals or higher cost value stuff. And probably like a lot of the investors here, we looked at all these projects and we couldn't find any that worked. So the reality, historically, I actually went through a bit of history of this region. What's worked here is gold and iron ore. So the first part of that answer is, what are we looking at hauling? We're looking at stuff that works, and iron ore works. So that's what we're focusing on at the moment. We might end up doing some other things, and we'll change our mind if the facts change. But right now, we think there's opportunity to expand iron ore. So therefore, we're looking for iron ore deposits. Unlike most exploration, development and mining companies, we don't have an exploration function. The bizarre thing about the Midwest is that, as I mentioned, billions of dollars have been spent. So we've currently probably got about 30 million tonnes of inventory. And we've probably got 3 or 4 years mine life at 4 million tonnes if we juggle those around. So we're out looking for deals. We can either do joint ventures, right to mines, acquisitions of the iron ore projects in the World Range and in the Midwest generally. The most obvious one is the one I mentioned, which is Sinosteel. They have 300 million tonnes within 30 kilometres of us. There are no plans to monetise those tonnes. So that's the deal we're working on. We're being incredibly patient because their original approach was, well, we're not sure we want to do a deal on the whole 300. We'll give you 10, here's Byrne, show us what you can do with that, and then come back to us. So my view is that we will do a bigger deal with our existing partner and end up mining 10 million tonnes a year from the 300 million tonne resource base that they have in and all around us. But that deal is not yet done.
I've actually got a question of my own. Bruce, I visited the Beverley Uranium mine, which is an in-situ leach in South Australia, and it is quite, if you haven't been to one of these, it is amazing. You get out of the car, used to all of your trucks running around and all the noise and, you know, the activity of digging dirt, and there's like, you get out of the car and it's crickets, and somewhere or other there's a truck with pipes on it and there's white spaghetti all over the ground and it's perfectly silent, and it's mining. Now, I understood that they were using a low pH, so a dilute acid at Beverley, and you're saying you've gone the other way and you're using baking powder.
Yeah, so the difference in the methodology is that, you know, depends completely on the geology. So it's just the style of geology in Wyoming, and that's
different mineral.
Well, no, there will be different mineral species in those tight marine arcosic sands because their deposition models are different environment. So the sands that we're in, they're not marine sands, so they're less consolidated, and the uranium was transported. Well, the theory is it was transported out of the granite mountains around into these locked basins. So, and look, deposits are obviously, no two deposits are really the same, but where we are, we don't need to use acid to break out the mineral from the sandstone. That's the basic answer. So there's some advantages with it. It doesn't mean it's necessarily 100% better, but
it's a highly mobile mineral, and neither of those solutions will tackle it. It is phenomenal that they actually leach uranium in an aquifer without anyone jumping up and down and protesting and carrying on about it. Been doing it for a long time, and the secret is you just suck more out than you put in. So all of the reagent that goes into the ground gets flushed inwards and pumped out and processed. And the only noise you hear is the loudest thing I heard was putting the lid on the drums of yellowcake down at the extraction plant. But fascinating, and definitely the cheapest uranium production in the world. So, anyone else out? Oh, one more over here.
Hi, my question's for John. Thanks for your presentation. It seems you've got very high lump percent at Iron Ridge, at least. Is that something you expect at your other deposits, Shine and W11?
Technical question.
We did outperform. The original feasibility was based on very little drilling, and I think quite conservatively they said 30% lump, and we've actually for a period of time got up to 50% lump. So yes, and we're getting a really good premium because it's actually got that grade in it, very low impurities. It's a combination of obviously the in situ quality of the ore body, but it's also related to the type of gear we use. You know, I mentioned, you saw on those videos, we're using small diggers, small trucks, and then also the thing that is for small scale producers, obviously it's one thing to produce lump, but you'll get a penalty if you have fines in your lump. And if you're hauling at 500 kilometres on a road and the train's bumping over, and if you're driving around places where there's lots of trucks, if they're doubles or triples, you'll always see lots of wobble. One of the things you'll see in the video, and if you drive in the Midwest, our trucks have been designed, they sit really stable. So we don't, you think about a Wilf table or something, we're not agitating the ore the whole way. So yes, we've got a really well-performing ore body, but even at Shine, we're getting 10% more lump than Mount Gibson were mining exactly the same ore body. We recommissioned their mine. And I think it's because of the approach we take to looking after the material, both the way we mine it, but particularly once you've mined it and you've got a stockpile of lump, keeping it in lump. Because, one of the things I talk to the site about is, you go out to the mine site and obviously we're all wearing PPE, you've got a hard hat on and safety boots and high vis and some goggles, and you get those. I quite like hanging on to those sunnies. I've got a few pairs of them, so we always put it in my pocket. And the mine manager at Iron Ridge said, "John, you haven't given back your sunnies." So I felt a bit embarrassed, and it's a real focus of his because he says, "Look, they're roughly $40 or $50 a pair." And if you think about what we try and aim to do and have done at Iron Ridge, particularly in our lump, is generate a $50 cash flow margin. So his point, and it's a point that he uses in trying to get a cost language in the company, is to generate $50 to buy a pair of glasses for safety, we've got to identify, mine, crush, screen, stockpile, load it into a truck, drive it 500 kilometres, store it in the shed, load it into a boat, send it all the way to a customer, and we get $50, and then got to do it again, a whole ton of material. It'd take a big part of this room. So we really try and look after the material, we try and value it, but ultimately, so it's a combination. It's the in situ ore body, but it's also the way we try and manage our products. Because we are in charge of the mining, we're in charge of the haulage, and we're stockpiling it. The one thing we can't control is what happens in the boat.
Yeah, great. All right, well, anyway, he lost his job, that guy. Just kidding. Daniel, we might make that the last one if that's cool. Unless everyone else is bursting, I think we've done really well here on time, but Daniel.
Just a question for Chris. What's your timeline around mining Drake?
When are you going to mine Drake?
Yeah, that is a good question. Our near-term focus is to grow the project with a scoping study. Like as people would be aware that approvals in New South Wales do take time. We're quite confident that with the historical data, again with historical EIS statements, that the pathway to mining is going to be quicker than you probably see with other projects that don't have any of that infrastructure. So think about McPhillamys, how much they needed to move forward. I mean, I think the cost Alkane built a tailings dam out near Tomingley, that was $16 million for them to get that permitted, and I don't know how many years that took to get done. The sunk infrastructure that they're certainly going to mean the timeframes in. We also do have, it's one thing to put, a 1.2 million ounce sort of resource into production. Our focus though is really on that tier 1 potential. So we're sort of really going to balance that with a project that we think could be a multi-million ounce deposit.
You wanted a year.
Yeah, well, definitely not a year.
So there you go. Not a clear answer, but anyway, lots of value there. Look, gentlemen, for all your efforts, we have this lovely gift, which is our motto here is think global, act parochial. This is a New South Wales gold nugget mined here in Hill End, and interesting historic note was that Mr. Holterman was actually a member of the Sydney Mining Club. You can see he's had it embroidered on his vest here.
Sure.
And you can see.
I'll believe you.
Yeah. It was. He wasn't very big. He was only. I think he was about 5'2", but or even less. But it was an extremely big nugget, all the same. That is the Holterman nugget here from New South Wales. It's a little memento for all the effort you put in being here tonight. John, you are the nerdiest iron ore miner I've ever met, but well done.
Thank you.
There you go. And put it up.
You're just trying to rub it in, aren't you? So the gold.
Yeah, the gold. Yeah, there you go. The gold's right. But anyway, look. Oh, shit.
It's a big nugget.
There you go. Yeah, there you go. Well done, boys. There you go. The men and their nuggets. So anyway, fantastic show. Thank you all for coming. Next month we have the New Hope Coal Story and Coal Australia, which is the new body created for promoting coal in Australia. It's a peak body of coal in Australia, recently created, doing exciting stuff, and New Hope Story. So there'll be a lunch down the road, and we'll see you then. Thank you.